Welcome to Poor Millionaires. Neil Woodford is one of the UK's best known fund managers, having famously avoided the worst of the fallout from the dot-com bubble and the financial crisis, which helped him go on to manage more than £30 billion at Invesco. These days, he shares his insights via his blog at W4.0, and in this episode, we'll be asking Neil whether he sees any signs of a market bubble and how investors can best navigate the current investment landscape. Poor Millionaires is a show for people with investable wealth of $1 to $20 million. We strive to educate, connect, and inspire, to give you the tools you need to thrive and secure lasting prosperity for yourself and for your family. PoorMillionaires.com. Invest with ambition. This podcast is for educational purposes only. The information does not constitute financial advice or recommendation and should not be considered as such. Value investments and any income derived from them can fall as well as rise, and you may not get back the original amount you invested. Welcome to the Poor Millionaires podcast, everyone, and a very warm welcome to Neil Woodford. Neil, welcome to the show.
Hi, James. Thank you for having me.
It's good to have you. So Neil, you were the UK's most influential fund manager for quite some time, and during that time, you made a name for yourself by sitting out some of the big market bubbles. Obviously, the dot-com bubble being one, and the subprime mortgage crisis and the accompanying bubble in banking stocks and financials. We've now gone for a long time in markets where it's paid very well to be a passive investor, and indeed passive investors have outperformed most active managers, given that the momentum in the market is being driven by these big mega cap tech stocks in the US. So first of all, I just want to get your view on the shift to passive, as a former active fund manager yourself.
Yeah, I think there are many positives about the move to passive. I think not least because, of course, it's low cost. So it's enabled investors to access equity-like returns in low-cost vehicles with diversified risk. So I mean, I think it's Jeff Bogle who set up the biggest passive firm in the world. He invented the whole concept in the first place. Look, I think it's served a very good purpose. But like all things, you can have too much of a good thing. And I think it's something I am concerned about in the medium and longer term. My issue is that if passive becomes too big, and certainly if you imagine a market that's dominated by passive investment, that's a very, very different world from the one that we're living in right now. Now, I don't want to really, the question, you don't really want me to go on for hours and hours about what the implications of a fully passive market might mean. But one of the implications, of course, is that it becomes very, very difficult for new companies to come into the market, to access public markets, to access capital from IPOs. The whole nature of the market changes. So if every index fund has got an index position in every company in a broader index, of course that destroys really the one of the principal functions of an equity capital market, which is to take capital away from industries that are declining, that have seen their zenith and are now declining, and there have been many examples of that over the last century. To take capital away from those industries and to allocate it to new growing industries. That process becomes very, very, very difficult. It's hard to envisage how it could happen in a market that was 100% passive. In fact, what you might end up doing is ossifying the entire structure of an equity market and actually ensuring the end of the equity market as a successful sort of functioning venue for investors to participate in, because what would then replace that, of course, is private markets with digital ledgers. I mean, you can imagine that ultimately a market that was dominated or completely dominated by passive investment would actually end. It would just come to an end. It would be eventually it would have created its own sort of destruction effectively. So I think I don't want to sort of dwell on too many details, but as I've said, passive investment has provided a great service for people, and people like Warren Buffett have always advocated for people who are not prepared or not able or equipped to do the sort of analysis that would enable them to make active fund management decisions, for those sorts of people to access passive strategies. And I agree with that, but there are limits to how far passive investment should go.
I guess part of the whole passive thing is it creates this kind of like herd mentality in markets, because you get kind of, things are allocated based on a market capitalization sort of weighted basis, and you've got you've got the Mag 7 stocks in the S&P 500 now making up about, I think it's like a third of the entire market cap. Does that kind of thing worry you at all?
It does, because I think at a time, I think more broadly, when markets are not overvalued, when buying a broad spread index of US industries and US companies, when that's not an overvalued index, and when you're participating in underlying growth in the US economy, a long-term strategy can deliver very good outcomes. The problem is that, as you've said, when a market is now more dominated by a very small group of stocks, the Mag 7, as you said, are more than a third of the index, and when the market itself becomes overvalued, you crowd people into you crowd investors. I mean, it's also worth bearing in mind that the US market has become utterly dominant in a global index as well. I think the US now is 75% plus of the global index. So anybody who wants to have either a sort of broad passive exposure to the US market or broad passive exposure to global equity indices, what they end up buying is all the same companies. And of course, if those companies are objectively overvalued, which most people would agree they are, and if what they're doing is difficult to determine what the returns are going to be, you're basically crowding a lot of private investment into businesses that, in an objective sense, you probably wouldn't want to. So I think there are risks. It's a very sensible long-term strategy, but at certain times and in certain market environments, I think it's quite a dangerous strategy. And I think that adjective would be very appropriate to use right here, right now.
And I guess the other thing is, I mean, you mentioned the fact that the US accounts for the majority of global market cap. But then on top of that, you've also got the fact that passive is now, the majority. It basically takes up the majority of the market in terms of fund flows.
Yes.
So you've got this kind of double reinforcing cycle thing that's going on here, and so I wonder, do you see any kind of like parallels between the current situation with all the hype surrounding the AI boom and the current sort of Mag 7 obsession and the .com bubble?
Yeah, there's sort of two elements to that question. So I'll sort of parallels I'll deal with in a second. So the first point is that I suppose as we've witnessed the rise of the US market, well, not the rise, but the preeminence and the outperformance of the US equity market, S&P 500, and as the Mag 7 constituents of that index have performed so very well over recent history, it's not surprising, first of all, that active managers who've been sort of underweight or who've been who like me have had a different view about valuation. You can understand why those active managers have been under pressure, and secondly, you can understand why passive strategies have attracted so much of a following, because of course they've been successful. But the two are very linked to each other, of course. The rise of the S&P 500, the dominance of the dominant outperformance of the US index, and the dominant outperformance of the key constituents of that index have all sort of served to reinforce the attractiveness of passive strategies that have an index weighting to those companies and that index. But the problem comes, of course, when that is driven to an extreme, and that's sort of what I'm saying is where we are now. I think we are at an extreme evaluation, and history has very reliably told us, anybody who's prepared to look at it has told us, that if you invest in any index, but if you invest in Wall Street, S&P 500, at multiples that are around where they are now, you are guaranteed, based on history, guaranteed to achieve very low real returns, if in fact negative real returns, over the next 10 years. So I think that's a really important precedent. Now, we could all, of course, be wrong. History might not inform the near-term future, but having been around for this industry now for 40 years, I don't think ignoring the lessons of history has ever been a good or advisable thing to do. I think there are many, many important lessons of history that apply and will continue to apply. So it's my understanding of, I think, my broader focus and understanding of valuation and its importance, its relevance, my understanding of history, of markets, and history of valuation. All these things tell me, inform me that I think a passive exposure to S&P 500 is not the low risk bet it was in the past going forward. That's the first one. Secondly, what are the parallels between the current AI boom and the dot-com bubble, for example? And I just wanted to say one thing. When you said I rode out, what I want to be clear is that I remained fully invested during the dot-com bubble and fully invested during the banking crisis. I didn't have 2024 sight. I didn't know what the key event was going to be that would trigger the market correction and the rebalancing that took place in the wake of both of those events. And for me, the much more troubling one was the financial crisis. But it was valuation that guided how I should structure the portfolio. And that guided me away from TMT stocks in 98, 99. And that same sort of valuation and analytical discipline guided me away from banks and financials in the lead up to the financial crisis in 2008, 2009. So when markets wobble, everything goes down initially. And then there's a sort of period of rationality. The initial sort of reaction in a market wobble is always irrational. Everything just gets smashed to smithereens. And then there's a sort of differentiation. Then there's some discernment and analysis, and then you get the winners and losers. And you've got to hold your nerve through that first phase to be able to benefit from what happens next. And certainly I did hold my nerve. I had positioned the portfolios correctly. And although in the initial sell-off, everything looks very alarming, you can then start to see how rationality returns to the market, and there's differentiation between the winners and the losers. It's important to bear that in mind. So something coming back today, are there any parallels? There are some parallels, but not many. This is a very different. All booms and busts are very. I mean, other people like to sort of bundle them all together and say exactly the same things. Lead to different outcomes. I mean, one of the things I spent a lot of time doing in 98, 99 was looking at economic history and looking at the history of markets and particularly market bubbles. What had caused them, how they'd been manifest, and how they came to an end. And every single one had there were sort of characteristics that I could see were the same as those that prevailed in the late 90s and the early 2000s. But equally, there were also differences. And I think it's important to bear in mind those same lessons today. So what I would say right today, is that the fundamental differences give me confidence that although there are bubble-like characteristics to the AI boom, we are nowhere near the sort of lunatic excess that we saw back in 99, 2000.
Sort of
There are
floating with just
crazy,
like a name of a website or something, and the valuation was sky high.
yeah,
We don't seem to have got that kind of hype at the moment.
yeah. I mean, one of the key differentiating factors is that the biggest, strongest, deepest financial pocketed companies in the world are the ones that are leading the AI industrial revolution. They're the ones that are spending the money. They're the ones that are building the data centers, and excuse me, they're the ones that are developing the LLMs. You know, and they're doing so from cash resources on their balance sheets and from cash flow. You know, that was not a key characteristic of what happened in 98 and 99. New companies were IPOing all over the place. Some of them had no revenue whatsoever. They just had an idea. I mean, it was a very, very different environment. Very different. Having said that, as I've said, there are some bubble-like characteristics, and it would be surprising if there wasn't, wouldn't it? I mean, at the end of the day, this AI industrial revolution is something that is going to affect all of our lives, not just here in the UK, but across the world. Every single family in pretty much every developed economy is going to be affected by AI. Every business is going to be affected by AI. It would be very odd if this such a ubiquitous sort of transformation in technology wasn't encouraging some sort of bubble-like characteristics in financial markets, and I think it is. But there's a world of difference between the sort of the early inflation of a bubble and the unsustainability sort of, you know, the sort of the imminent crisis that leads to a messy deflation of the bubble. Is one other important. So I don't, by the way, think we're anywhere near that point. Secondly, not all bubbles end catastrophically. There was a bubble in Wall Street in the 60s and early 70s. The Nifty 50 got onto some absolutely crazy valuations. The valuations of the Nifty 50 make today's valuations of the Mag 7 look very cheap. And that bubble didn't, that sort of valuation bubble didn't end in some sort of event where there was a sort of massive market sell-off and crisis and everybody was panicking. It just, the investors in that Nifty 50, in those very highly valued stocks, basically spent the next 10 or 15 years, maybe some of them even 20 years, achieving very, very poor returns from those companies. So it is not predetermined that the AI bubble sort of is about to implode, or that it will implode in some sort of spectacular event in the near future. I just don't have. Nobody has that sort of visibility yet. There's a long way to go. When you think about, we are only in the foothills of this AI industrial revolution, in my view. You know, although ChatGPT has got 820 million customers, you know, we're only really very vaguely understanding now the applications or the potential of the technology, where it can take us, how much productivity, what the productivity gains might be from it, what might be the revolutionary medical science developments or fusion energy technology developments that will come from AI, the deployment of AI, AGI, for example. We just don't know. We don't even know when AGI will arrive, or even where artificial superintelligence will arrive, even if it is achievable. Many of these things are unanswered. And of course, if you listen to, as I have done quite regularly, listen to what Elon Musk is saying, I mean, you know, he's much more excited about robotic technology, about humanoid robotic technology and the potential that has for his businesses than he is about Tesla or sort of. I mean, I think he's pretty excited about Grok and you know, as a model and as an AI tool. But I think he's seems to be more excited about the ubiquity of humanoid robots, for example. Now we haven't even started that particular sort of industrial revolution yet. So I think there's a very, very long way to go. And to some extent, final point, I've gone on quite a long time, but the final point is financial markets tend, when they get to an unsustainable level of bullishness, which you would characterize as, a market bubble that was about to burst. Every time I've seen one of those, they have recruited nearly everybody. I mean, there are only a few holdouts, like I was back in 2000, and I was really only just hanging on to my job. If it had gone on much longer, I think I would have been asked to leave. The nature of bubbles is that they recruit everybody. Everybody buys into the sort of euphoria. And I think in this case, the mere fact that we're talking about it now, and the fact that I am literally bombarded with podcasts and chat and commentary and interviews highlighting how it's all about to go very horribly wrong, tells me that this story has a lot further to go.
I just want to dig into that whole period a little bit in more detail, Neil. So, during the tech bubble, so obviously you faced a lot of pressure, didn't you, to kind of cave in and sort of follow the herd. The rest of the fund managers were all kind of piling into this stuff. How did you sort of maintain the mental fortitude to kind of just stick to your guns, and what lessons would you draw from that experience?
So fundamentally, being an active fund manager does require you to do things differently. Okay, there are lots of people who would profess to be active fund managers, but actually, if you look to their portfolio, what they've got is a closet index fund. Now, I've come across lots of those in my career. Genuine active fund management is by definition differentiated. You're doing something different. Sometimes it might be so different that you look extreme, as I did back then, and as I looked extreme at other times in my career. It requires a number of things. It requires reasonably strong character. You've got to believe in your discipline. You've got to believe in the arguments that you deploy. You've got to believe in the process and the answers that it gives you. It's very easy to succumb to the noise. It's the same in life, isn't it? Generally, I mean, I think it's quite hard to be to carry an alternative view, but if you are carrying that alternative view, the confidence that you have in that view has to be informed by hard work, analysis, research, discipline, which apply in life, but also apply in business and in the activity of active fund management. Now, it's not always the case that you are doing everything very differently. Sometimes active fund management can look like an index outcome. I mean, there was a time in my career, believe it or not, I was criticized for having a fund that looked too like the index. But equally, you've got to be prepared if your process, which is well researched and is well founded, if that process tells you to do something, then you've got to have a really good reason not to do it. And in a way, the confidence I had at the time was that I believed my process was my investment process, and my valuation focus was well disciplined, well argued, and an appropriate thing to do. And it told me that what was going on in the market was mad. Now, nearly everybody that surrounded me told me that I was going mad, that you've really, a lot of it was quite artificial, because I think most people sort of bought into it against their better judgment. That was an interesting and worrying characteristic. And it's very hard. I mean, there's a great book, an investment book written, Popular Delusions and the Madness of Crowds, which was written, I think, in the middle of the 19th century, about bubbles. And I read it at the time. And one of I mentioned this earlier on, that, every bubble is different, but some have some characteristics. And the sort of characteristics that are the same in all bubbles is that they recruit lots and lots of very smart people. And in the process of recruiting them, everybody buys into the sort of the cult belief. I mean, Isaac Newton, arguably, the greatest scientist mankind has ever produced. He was recruited into one particular financial bubble. Even a man of his towering intellect sort of succumbed, probably against his better judgment.
It was a South Sea bubble, right? Yeah.
I think it was, yes. And so you've got to be, first of all, in an environment that might allow you to be different, certainly, and not all fund management groups, not all active fund managers are allowed to do what I did when I was very different. They are constrained by risk budgets and things like that. I had the scope to do things very differently, but when I did do them very differently, and when that resulted in underperformance, and when that resulted in outflow from the funds and economic consequences for my employer, that's when it got really tricky. But I think the thing to be, at the end of the day, if you haven't got the courage of your convictions, if you don't believe in what you're doing, in good times and in bad, then don't do it. Go and do something else, is my view.
So I guess the only way that people can outperform is by doing ththings differently to the market at large. I guess the flip side of that is that you can also underperform. And obviously, recently, as we've alluded to, a lot of these active investors have underperformed the index. But if we are looking to go down that route, and we want to kind of we're a bit worried about the valuations of these tech companies, and we want to look at something truly sort of off the beaten track, where would we look?
This is the thing. Economics, financial markets typically are about winners and losers. And just as when things become super popular, almost by definition, other things are becoming super unpopular. And I've always found in my investment career that that it pays to go looking in the super unpopular areas of the market. And there are now super unpopular areas. So even in the US, where I think the index is overvalued, and where I think valuation is very stretched in many parts of the market, equally there are lots of interesting opportunities. So I've spent the last 40 years rummaging around in the sort of lost property box, if you like, in the bits of the market, financial markets, which have become unpopular for all sorts of reasons, where valuation is depressed, where people are very bleak about economic and corporate prospects. It's always in those areas that I found the greatest and richest opportunities. So right now, I think the UK is an outstanding opportunity. Outstanding. There are parts of other markets which I think look really interesting to me. I said at the start of the year that China looked very interesting. China, I mean, some mainland China companies and certainly those listed in Hong Kong, and that's proven to be right. They both perform very well, but I still think there's lots to go for there. So yeah, I think it's sort of instinctively I'm attracted to, as I said, that sort of bargain basement, but it's sort of it's neither is it the pound shop, because you're not buying cheap companies. Aren't bad companies. They're just their valuations are low often for all sorts of irrational reasons that aren't well argued or well thought through. They just are sort of, they've been the victim of a sort of herd-like mentality, moving through a market, and as a result of that herd mentality, they've underperformed. They're unpopular almost by definition. Because they've underperformed, they're unpopular. The most popular stocks in the market are the ones that have outperformed, inevitably. And it's those opportunities that I think are the most attractive on a longer term view.
So if we look at the UK, then obviously valuations look relatively cheap. If we look at other regions, but what about the wider context? Obviously, Brexit kind of put a real dampener on the UK in terms of the stock market and the attitudes to the UK. But what about the wider investment context? I mean, how would you describe the UK right now?
Okay, so the UK equity market has been uniquely battered in a way for the last 2 decades or more. It all kicked off really at the end in the 1990s when regulations changed in the pension industry, and essentially corporate pensions, instead of being off balance sheet assets and liabilities, legislation changed to bring onto corporate balance sheets pension assets and liabilities. Now, for many companies in the UK, those assets and liabilities were bigger than the assets and liabilities of the operating business. Certainly, for example, a very famous case was BT, which was described as a pension fund with a subsidiary telecoms business, or words to that effect. So what then happened? And this was entirely predictable. I said at the time, this is what will happen as a result of this change. But what motivated this change, by the way, was, I think, sort of what happened as a result of the Maxwell pension scandal. But anyway, for all sorts of reasons, legislators thought it was a really good idea. Regulators embraced it, and off we toddled. So the UK decided that, it was an international sort of accounting convention as well, but I think the UK was overzealous in its implementation. Anyway, so in the UK, at the time, UK pension funds were the biggest owners of the UK equity market. I think in total, UK defined benefit pension schemes owned something like 60% of the UK equity. I can't remember the precise number, but it was a huge proportion of the UK equity market. Once those assets and liabilities came onto balance sheets, and once the process of valuing those assets and liabilities shifted to, as a result of actuarial science, the way they were valued was effectively a function of discounting. The liabilities of a pension fund were discounted at the prevailing sort of corporate bond rate. And because interest rates went through a very long period of falling significantly, and as you know, in the wake of the financial crisis, they were basically zero. I remember Sanofi issued a corporate bond in the wake of the financial crisis with a negative coupon. That will go down. I said at the time that will go down in history as one of the most extraordinary things you'll ever see. But nevertheless, so in other words, people paid Sanofi to lend money to it. The concept seems bizarre. But anyway, that was what was happening. So when interest rates fell as much as they did in the wake of what happened in the late 90s, and essentially the reforms were implemented in the early noughties, as interest rates declined and as they ended up being effectively zero, the discount rate that you applied to future liabilities became very, very low. So those future liabilities looked absolutely massive in the context of the assets that were there to meet them. And as a result of that, pension deficits grew, and companies did their best to start making good on pension deficits. And there was a huge amount of money transferred from P&Ls into pension schemes to close the deficit gap. Now, alongside all of that, of course, if you're an FD of an operating business, whatever it is, and your job and your remuneration and your whole sort of world is about trying to improve the profitability and results of your operating business. But everything that you do is sort of outweighed by the volatility of the financial markets and interest rates because of the pension assets and liabilities that are on your balance sheet. You've got an incredibly confusing picture. So what corporates did was say, well, we've got to get rid of these pension assets and liabilities. We've got to get them off our balance sheet. Once we've made good the pension deficit, we've got to neutralize the ability of the liabilities to affect our operating business. So what happened was essentially a liability matching strategy. The volatility inherent in equity markets just didn't go well with that creed. So as a result, the fund managers or the people who were in charge of those defined benefit pension schemes sold all of their equities because they couldn't stand the volatility of the assets, and they bought effectively gilts or index-linked gilts to match the liabilities that they had in their pension schemes. And as a result, the biggest owners of the UK equity market sold all of their UK equity exposure. That's one thing that went wrong. That, by the way, was entirely predictable. And I think not only damaged the UK pension fund, not only damaged the UK equity market and the UK economy, but it clearly also damaged the beneficiaries of the schemes themselves because they were locked into very low return assets. Anyway, madness. Also, the FCA introduced loads of reforms. MiFID 1, MiFID 2 were particularly damaging to the UK equity market. Won't bore you with the detail, but they were damaging. And then after those reforms, we had a series of sort of pretty challenging issues. If you look back at the period, really over the last 15 to 20 years, you've had the financial crisis. I mean, that was an existential, particularly difficult for the UK because the banking industry was so big in relation to the economy. But that was a near-death experience for the UK economy, very near-death experience. We then went through a period of very low interest rates, deflation, all sorts of weird things like QE going on to try and sort of stimulate the economy. Consumers are still really living now with the legacy of and certainly banks are living with the legacy of the financial crisis right now in terms of regulation and capital requirements, etc. And certainly mortgage availability is in large part driven by the rules and regulations that were put in place after the financial crisis. Anyway, so after the financial crisis, banks were constrained, understandably, because they had to rebuild their balance sheets, etc. All sorts of, and then we sort of ran into the pre-Brexit and Brexit thing. Now, although I don't think and I've argued this in a recent blog, although I don't think the event of leaving the EU has actually noticed, I think it's really hard to identify any damage to the UK economy as a result of the UK leaving the European Union. I'm very confident that the whole Brexit sort of omni-shambles certainly did undermine international investor confidence in the UK. And of course, in the wake of the vote to leave, lots of international investors sold the UK equity market. This is a very long answer but I think it's worth going over the detail here, James, just because it's really important to understand why the UK equity market is so cheap. So, financial crisis, pension reform, financial crisis, Brexit omni-shambles. Basically, although it didn't damage the economy at all, in my view, and I've written about that and provided evidence to support that assertion, it did result in lots of international investors selling the UK equity market. And then we sort of bumped into the pandemic. And then we bumped into the war in Ukraine. And this period has actually been very, very challenging for all sorts of reasons. Some of them not necessarily unique to the UK, but uniquely badly applied to the UK, okay? In some respects, I think the management of the pandemic in the UK was an absolute disaster. I think the government just were appalling at the time, and they did some really, really stupid things. Anyway, and then of course we had the war in Ukraine and the sort of inflation, interest rate spike that followed that. So investors, understandably, are pretty sort of leery about the UK equity market. But all of these events have contributed over a period of time to this sort of the progressive devaluation or derating of the UK equity market. The reality, however, is that the UK economy is actually nowhere near as bad as people think. It's actually performed pretty much in line with our European peers. We've underperformed the US economy, but broadly, the UK economy has kept pace with our our EU peers. I think we're better placed now to grow more quickly than the EU going forward. There are many things about the UK that I think tell me that the UK economy is about to deliver much better growth than is forecast. So, in summary, all of those events have resulted in the derating of the UK equity market. There's no fundamental economic reason or market reason for the unbelievably low valuation of UK equities, other than investors have just been subjected to this sort of long series of events that have undermined confidence in the UK equity market. But they're now behind us. What is in front of us is, I believe, a period when the economy will outperform expectations. But combined with that, I think it's important to understand that it's hard to see what more can be thrown at the UK equity market. All the natural owners of the UK equity market have sold. International investors have largely sold. The UK equity market is a tiny proportion of global indices. Valuations are low historically and by comparison with peers. And yet the UK economy is going to do well, and so are the UK companies that are listed in the UK. So in my view, it's a very sort of broad summary, but basically that's why the UK equity market looks really attractive in a very sort of macro sense.
What about the fact that the UK equity market has shrunk it's gone from, what was it, over 3,000 companies to around about 2,000 companies these days?
Just a bit, yeah.
What about in terms of like how, because it's important to have a vibrant equity market, right?
Yeah.
And I think London now seems to have, there's a bit of a narrative out there that London is kind of losing its place as an important global equity market. So what would you say to that? But also, you've got a lot of experience when it comes to the Woodford Patient Capital Trust that you used to manage in terms of early stage companies and helping to commercialize companies out of universities. I mean, we're not going to go into detail about talking about Woodford Patient Capital, because I think other podcasts have done that, but just give us a bit of an insight into what are the problems with commercializing technology specifically in the UK, because we've got an amazing university system in the UK, but we don't seem to be able to commercialize and capitalize on this technology and this innovation that's coming out of these universities. And also, third point, are there any kind of like easy wins in terms of a policy perspective that you think that could really make a big difference?
Wow. Okay. That's three big questions. Let me try. So I'll deal with them in order. Has the UK equity market shrunk to the point of irrelevance and non-viability? No, I don't think it has. I mean, the data are pretty alarming. I mean, I think there are more IPOs in markets you've never heard of than in the London market, which used to be second only in IPO activity to Wall Street. It is worrying, depressing, and disappointing that the government and regulators don't seem to recognise the significance of this sort of underlying deterioration. it seems that they don't really understand the primary and critical role that the UK equity market performs for the UK economy and for companies that need access to capital, growing companies. It's astonishing to me that the governments, successive governments, have just walked past this as if it was just some trivial thing in the background. It's astonishingly how bad that situation is. Having said that, I don't think the UK equity market has shrunk to irrelevance. I think it can be revived, and I think there are relatively easy wins. You asked about easy wins. I think there are relatively easy wins and easy reforms that could be implemented that could change that situation. The major problems really are in the small and mid-cap parts of the market where it just isn't economic now for brokers to support businesses. They can't earn fees through brokerage relationships. They get sort of relatively basic retention fees, but the sort of fees that they would earn, brokers used to earn from writing research or promoting the interests of promoting companies to which they were broker, from the transactions that those companies would do, from the IPOs, from the M&A that those companies would undertake. All of that has evaporated, and there are good reasons. I mean, that is a direct product of frankly, the MiFID reforms, which have been a disaster. The opportunity, of course, is to reform MiFID 2. If some of the worst aspects of MiFID 2 were reformed and changed, you could transform the prospects for the UK mid and small cap. But that requires insights and understanding from government and regulators, which is not evident right here, right now. But that could be an easy win. What else could be an easy win? The government has been toying with this idea that it would sort of mandate pension funds to invest a minimum proportion of their assets in the UK economy. Now, by the way, it's important to understand that the proportion of assets that UK pension funds own of their home market is a massive outlier in comparison with almost all other developed economies. There is no other economy globally, developed economy globally, where the largest domestic financial institutions own such a low proportion of their home market. I think basically in total, UK pension funds now have about 2% of their assets in UK equities. By the way, they own quite a lot of international equities, 3 or 4 times that. That is appalling. That is an indictment of the situation. I mean, and bear in mind, of course, that UK pension funds receive tax benefits from the UK taxpayer. So whilst they're on the one hand saying, yeah, thanks very much for the tax reliefs that we get effectively, we're not going to invest in the home market. I mean, no other government anywhere else in the world would accept that, and I don't think ours should either. So although, lots of people are up in arms about the government mandating investment in the UK, the fact is that I think it's appropriate. Now, we've got to be careful what we wish for, of course, because the pension funds do own a lot of government debt. And I wouldn't be advocating, you sort of sell down your gilt holdings and start buying UK equities. I think that would probably not work. Certainly for funds that are now in running off and need to match assets and liabilities. But I'm finding it hard to understand why these pension funds still own significantly more global equities and international equities than they do UK equities. Whilst at the same time saying, thank you very much, UK taxpayer, we'll continue to benefit from the tax reliefs that our beneficiaries and the funds enjoy, delivered by the government thanks to the taxpayer. So I just think that's an unsustainable situation. No other country would put up with it. We seem to have done so, but I think there will be an easy win by saying, well, yeah, if you want to still continue from a beneficial tax regime, you know, UK equity assets have got to form a greater part of your equity holdings. So there's an easy win. Easy. It requires insight, intelligence, somebody to grapple with this problem and to think about how solutions could be implemented. But we're never going to get to solutions until that problem is identified and seriously considered. So I think there are things that can be done relatively quickly, relatively easy, that wouldn't cause harm, that would actually benefit the UK equity market and might lead to its renaissance. By the way, I still don't believe that the UK equity market's outperformance requires any of these things to happen. I think that will happen anyway, but I just think these things could help it on that journey.
Yeah.
The other thing to bear, and you talked about early stage companies, yes, this is another significant failing, market failing, which the government has had periodically. Whitehall has had periodically plenty of insights into. There have been numerous investigations. I was a part of one back in 2016 that looked at why early stage science and technology companies weren't getting proper access to capital. And frankly, the answer really lies once again with what I've just been talking about with UK pension assets. I mean, ultimately, long liability pension schemes, long liability funds are the ideal vehicles to invest in early stage equities, early stage companies, because, early stage by definition indicates that the returns are sort of longer term. They don't pay high dividend yields, for example. They require patience and capital to deliver the outcomes that we all hope that they will. Not all of them make it, but a much higher proportion would have made it had the UK capital raising environment been more benign than it has been. And in recent years, in the last 2 decades, it's been incredibly difficult for UK science and technology companies to access capital in the UK. So what do? They get money from Europe, they get money from the Far East, they get money from Middle East, they get money from the US. And all the benefits accrue to those investors and not to UK investors. It's a travesty because, as you rightly point out, UK universities are amongst the best in the world. Oxford has repeatedly topped the league. Oxford and Cambridge have repeatedly topped the league tables of the best universities in the world. And part of that assessment looks at the sorts of technology that emerges from those universities, the sorts of insights, the Nobel Prizes that they win, the scientific papers that they write, the new discoveries, the new scientific discoveries that come out of the research departments at these universities. And Oxford, Cambridge, and there are many others. I mean, University College London, Imperial College, Manchester. There are a whole series of great universities doing great work in the UK. The problem is none of it gets commercialized here in the UK. UK investors completely miss out on that opportunity, and the economy misses out on the opportunity to commercialize and develop these new technologies into viable, scaled enterprises that employ people, employ particularly, the sort of knowledge economy jobs, and pay taxes and create economic benefits for the country. We have completely walked past that opportunity for about the last 25 years. It's a travesty. It's a product entirely of the lack of political understanding of the problem and the lack of any political will to try and solve it. And it's been compounded by all the things that I've talked about already with respect to UK financial institutions with very long liabilities and deep financial pockets, basically just turning the other way and investing anywhere else but the UK corporate sector. So, there are many, many problems. Fortunately, those universities continue to churn out great science and technology. I'm still in touch with I mean, yesterday I was having a great conversation with a company based in the UK that's developing, trying to develop therapeutic for a rare genetic condition. It's a great little business, fantastic technology, great insights. The technology actually, on this occasion, didn't. The early developed technology didn't come out of the UK, came out of the US. But anyway, that's beside the point. The point I'm going to make is it's highly likely that the capital that company raises to develop that technology won't come from a UK investing institution. It'll come from an investing institution somewhere else. And it's tragic that we still are struggling as an economy, and that incredibly bright people with great ideas, with great technology are not really able to develop their technology, to commercialize it here in the UK, because there just is not the capital that's available. It's probably the single biggest economic own goal this economy has inflicted on itself in post-war Britain's history.
Neil, we've covered a lot of ground. I'd love to get you back on at some point to discuss things in a bit more detail. But for now, can you tell our audience where they can hear more from you? Because I've been following the blog, been enjoying the analysis. So please let us know.
Well, thank you, James. Yeah. So I launched a blog initially called Woodford Views in April last year. So that's now nearly, well, it's over 18 months old. And then we launched W4PZ, which is W4.0, which is a combination of, really, it combines lots of all the material that I write for the blog, but additional material as well. And it's essentially a platform that is designed to help investors make better investment decisions for themselves.
Excellent. Neil, thanks for your time. It's been a pleasure.
James, thank you very much for having me on your podcast. Thank you very much. Really good questions. And I hope I sort of addressed all the issues that you asked me to.